Welcome to the Wealth is in the Details podcast. In this podcast, financial planner Peter Raskin helps families and business owners understand and prepare for their wealth journey. Along the way, thoughtful and detailed planning can provide clarity and confidence as clients confront a multitude of financial decisions. Listen in as Peter shares stories and insight into people's wealth journeys. Now, let's get into today's podcast.
Hello and welcome to Wealth is in the Details with Peter Raskin from Raskin Planning Group. Today, Peter has a guest, and that special guest is Jeff Wildermuth, a portfolio strategist at Aris Investment, a division of AssetMark. Eris specializes in building sustainable or socially responsible investment portfolios for individuals and families. Peter, how are you today?
I'm doing great. I'm really excited about today's podcast. I think it's just a really interesting subject.
Yeah, absolutely. I've heard of socially responsible investments. You and I have talked off air before about different strategies and different things like that. So I'm really excited that you brought Jeff on the show today.
I am too. So Jeff, why don't we begin? Why don't you tell us a bit about yourself and your firm, just to give our listeners a sense of where you're coming from.
Yeah, well, first of all, thanks for having me. Certainly appreciate the chance to talk about this. I've been in investment strategy for probably about the last 20 years or so. First with a firm at SCI, just outside of Valley Forge, and in the last 6 years with Eris, as was mentioned, a division of AssetMark. Specializing really in goals-based investing, spending a lot of time on getting to investor objectives and building commensurate portfolios to meet those objectives.
So, Jeff, tell us a bit more about Aris as a firm.
Eris was really started around the mid-1970s in the State College area. Really brought along in the last couple of decades the ecosystem that surrounds the university. So pensions and foundations, employees of the university, the town that obviously has sprung up around that. There's certainly a lot of diverse needs, a lot of investment strategies that need to be created to service that community. And it's been very much a community firm since its inception.
Now, Aris specializes in sustainable or socially responsible investing. And could you give us a kind of a brief review of that kind of strategy and just give our listeners a sense of what it's all about?
Absolutely. I think it's really critical. When we talk about sustainable investing or socially responsible investing, some people refer to it as impact investing. What we really sort of identified in the conversations that we were having with advisors and with investors over the last, decade plus is really sort of a desire to have input into the portfolio, right? To have a say in either, companies or allocations, or approaches that maybe didn't agree with, investors' beliefs or what they were trying to accomplish. And really now in the last couple of years, a desire to really get impactful type of investments in there, having investments in portfolios that serve the greater good. So the portfolios that we've built over the last 10 years have been fluid to sort of respond to that and adapt to that messaging that we're getting from the market. So, for us, it was really just a natural outgrowth of the conversations that we were having when we were interacting with advisors and building portfolios to sort of drive home, does the portfolio meet what the client is looking for?
Yeah, one of our earlier conversations, Jeff, you mentioned that this was not an approach that came from Eris. It's an approach that's come from the marketplace in a sense, and you've brought that many steps forward. But I thought that was really interesting.
Yeah, it's been a very organic kind of process, this entire movement around ESG. Peter, it's a great point that, most of the time, having been in the industry as long as we have, we're so used to strategies being sort of created, in a laboratory somewhere and then brought to market to then sell to investors. And, this is very much the opposite of that. This type of values-based investment approach is very much directly attributable to what the marketplace wants and what they're telling us is important. And that's certainly a very refreshing aspect to this, is that we're able to sort of meet in the middle in terms of taking investment thought leadership and investment acumen and market experience on our side and have it meet where the clients are coming from, which is having some input and say in the portfolio, being able to have a little bit more transparency into the companies that he or she owns. It's certainly a different dynamic, I think, than you would agree that it normally is the case.
Yeah, definitely. What's your sense? Why is it that investors in today's age are concerned about this? What's brought it to where we are now, and then who are these typical investors?
Well, it's a good question. I think certainly the availability of information, it plays no small part in this. We are inundated with and able to access information at record speeds. And so it naturally leads to a curiosity about what can I see? What about that peering through that sort of curtain that was previously there allows me greater insight as an investor. That's certainly a big part of this is that there's just, I think, a desire because there's an availability for investors to partake in this in a way that they couldn't before. So that certainly is a big part of it. Two, I don't think we have to, think too hard about what we're seeing and hearing every day in terms of just a very highly charged atmosphere, whether it be, environmental, which obviously dates back and where most of these values-based portfolios started, to more now around the social and the governance aspect. There are, issues that people are willing to tackle. They're anxious to address them. And I think that's part of this as well. You're seeing a little bit more of an activist generation, not necessarily, younger as in, right out of school, though that certainly is part of it too. But, you have a generation of investors that want their portfolios to make a difference. And so when you have that availability of information and this desire to sort of make a change, or at least be able to have some control in a world that sometimes feels out of control, are certainly huge drivers of this movement.
So it seems to me like the investor, the many investors are asking more from the companies that they're investing in. They're saying, we want certain kinds of behavior, and we want evidence that you're implementing that kind of behavior in your day-to-day work. And companies have responded, and they are providing some of that data. Is that accurate?
I think it's absolutely accurate. And I'm glad that you brought that up, because it also, ties in with, AssetMark and Eris are obviously investment management firms, as are, the Goldmans of the world and JP Morgans and so on and so forth. Well, not only are we being asked to create strategies that meet those standards that investors are demanding of us, but we as companies, to your point, have to start thinking about, are we walking the walk, right? How does our firm deal with our labor force? And how is our company, if we're publicly traded, which AssetMark is, how is our board comprised? What are we doing to better the community? So it's really, we're almost as up close and personal to it as anyone, because we've been building portfolios to meet that need. And now we as companies are being held to that same standard.
Yeah, which is, I think, a good thing.
I think so too. I think so too.
So how does this kind of strategy, this what we call ESG investing, how does it actually get implemented? Paint that picture for us.
Sure. I think it's probably to put it in terms of just broadly speaking, what is it that a portfolio like this is attempting to do, and then we can talk a little bit about what that process might entail. But generally speaking, when we talk about a values-based portfolio, whether we have sort of a faith orientation or more sort of an ESG orientation, we're looking to basically base stock selection on a set of criteria that adds in that lens, right? So not only does a company have to be, attractive from a valuation standpoint, or show earnings growth, or be able to have a very competitive edge or moat, if you will, there has to be additional characteristics of that company that make it attractive from this sort of values-based perspective, right? Are they carbon polluters? Are they offenders in terms of child labor laws, right? Are they engaged in product involvement that is objectionable? It's simply sort of an extension of looking at a company through the traditional lens and adding this sort of additional perspective onto it to determine, is this the kind of company that I want to own in my portfolio. So from that standpoint, I think that the thought process behind it is pretty direct. Generally what we're trying to do is screen out those names that are problematic or objectionable, perhaps be able to include some companies that are very positive influencers, score very well as it relates to these metrics to sort of boost that component of the portfolio. And then also have sort of this element of advocacy, whether the investment managers we're utilizing are directly engaging companies to try and change policy, or if they themselves are giving back to their community through programs or otherwise. We're looking for that sort of third component, right? So not just to get rid of stocks, not just to look at ones that are good, but then what kind of impact are we having on the world around us? And that in totality is what we're trying to deliver inside of an investment portfolio.
One of the things that my understanding is being done is that there's a scorecard. You're gauging a company's commitment to good behavior, or what you would define as good behavior. So talk a little bit about that scoring.
Yeah, and I think it's really important to realize that this is still a very fluid and sort of nascent movement, right? We're seeing tremendous impact and inflows and interest in values-based portfolio. But as it relates to scoring, we're going to continue to, as many of the other providers out in the environment are as well, to fine tune that. But in general, what we're thinking about when we're scoring a company is really kind of two building blocks. The first is, what are the inherent risks from an ESG standpoint that a company has just by being in the business that it's in? And then how does management address those risks? So if we look at companies like, media companies, and that could be any of the mega cap names to just something that's a little bit more simple, there is a lesser sort of, generally speaking, ESG risk associated with those names because they aren't out there drilling, in various parts of the world, or, dumping, their byproducts into rivers and lakes and so forth, right? There's a smaller footprint that they have. And so from the very get-go, you might look at a technology company versus a multinational oil company and say, well, the material risks that are built into their businesses are different. So one is certainly more attractive than the other. But the way that you can sort of compensate for that, or at least be able to maybe level the playing field, is how does that company go about doing what it does? How does it run its business? How does it treat its labor force? What are its supply chain relationships? What are some of the other aspects of its business that might call into question their viability from an ESG standpoint? Now, I use companies like Amazon, with obviously some of the recent labor strife that we had last year, does not score particularly well in that regard. So even though, Amazon is ubiquitous at this point, has basically taken over the world as just a retailer, and what many people would think, generally speaking, doesn't pose that much of an issue from an ESG standpoint. They have, facilities that they're building. I can't turn around without a truck being, passing me on the road that's making a delivery, right? So you certainly have emissions that are kind of coming from that. And then you have this sort of ethical component to it. I'll use another company like Wells Fargo, right? A bank, obviously a very blue, bellwether blue chip kind of company, long-standing and so forth, but obviously some ethical concerns in the last couple of years around opening up accounts, right? Sometimes the business itself at first glance might not seem problematic or objectionable, but how they go about it certainly can. And so that's where we're sort of trying to get at that management component. And so you can find oil or energy companies that score really well because of what they're sort of delving into, or the management around the risk that they have, and low scoring companies in terms of just inherent from their product involvement, but their management is very poor and leads them to a higher risk score. So it really takes both of those elements together to look at a company in totality.
Mm-hmm. So you're not necessarily screening for against an industry like a fossil fuel industry. You're not saying we're never going to own those stocks.
Yeah, energy is a great sector to look at when it comes to a question like that, right? Because energy is a very broad and generalized term. So even though there is an energy sector of the index, energy names are very different, whether you're drilling for it or, piping it from one place to another or storing it or moving into things like renewables or wind, right? All these companies fall under, the auspices of some utilities of energy. And so the way we approach it is, we'll look at energy in kind of subsets. So it could be things like thermal coal. It could be palm oil. It could be oil sands, right? Things that are destructive directly to the environment, that are problematic in terms of just, energy usage or land usage. And we might look at those companies as being what we would want to quote unquote screen away, but staying away from a generalization around energy. So your point is well taken that we could very well end up with, a name that maybe 10 or 15 years ago would have raised some eyebrows. I come back to Exxon quite a bit because of just this massive push into cleaner energy. Some of the partnerships that they've forged, the fact that their board composition has changed fairly radically within the last year or two in terms of having a very activist, environmental, eco-friendly aspect to it. So while we might not own that company today, there is certainly a difference between when scoring an Exxon versus maybe a Chevron versus a Royal Dutch. And so that's one of the reasons why looking at ESG scoring is so interesting, is that you can really get at the nuances of these companies and score them on their merits.
Yeah, I just think this is just so fascinating to think about all the aspects that can go into a company's score. And I think it tells you something about their broad perspective and, how are they dealing with diversity up and down in the executive, amongst executives, the board, employees, diversity, equity, inclusion. How does a company deal with all those things? And I think there's evidence that those companies that deal with those issues well and are diverse can be more productive, can be more creative, can have better long-term results.
I mean, that's certainly the thesis, in an indirect way behind what, a values-based portfolio is, right? It is almost by default, in some ways, a quality portfolio, right? You're betting on quality to rule the day. And so if you have companies that are able to minimize risks that they can control and be able to, adapt business models and be able to adapt personnel, the thought there is, certainly in a period like, March of 2020 or, dating back to, 2008, it's not to say that these companies, won't go down, right? Or they can't suffer through periods of weakness. But generally speaking, the thought is these companies are by default perhaps positioned better to recover because of this thought given across their business to all these risks that could potentially dent the stock price, right? So I'll use two further examples. The first would be Tesla within the last year or two. I've referenced the fact that, on a number of occasions, Tesla is looked at very much as, a darling in terms of the electric car space, certainly one of the first and most powerful movers. And so, on its surface, right, an investment in Tesla seems like something that's good for the environment. But when you hear of them talking about taking Bitcoin as a form of payment, or perhaps even investing in Bitcoin, something that which comes off as just a kind of a headline, one day kind of a headline, actually does have impact because Bitcoin, whether you feel good or about it, bad about it as an investment, has an environmental impact to mining it. And so there's a negative sort of mark that goes against a firm like Tesla when they come out and talk in that fashion or even engage in it more directly. And if you'll remember correctly, I think Elon Musk actually backed down a little bit from that position. So, that's certainly the kind of thing that we're thinking about here is, in totality, everything that a business touches, the way that it goes about, engaging the public, manufacturing its product or service, there are ripples, if you will, like throwing a stone into a pond.
Yeah, interesting. From an implementation standpoint, how does Aris implement these investment strategies?
There are two main approaches to what we're doing, whether it be a mutual fund only approach or what we refer to more as a custom high net worth approach. They're both based on very similar thinking. And that is we're engaging third-party managers to round out our proprietary asset allocation. And we do that because it's an acknowledgement on our part that there are experts in the field in large cap and small cap, international and emerging, that have ESG built into their core, into their philosophy, and into their identity, dating back decades. To be able to tap into that skill is a really critical deliverable on our part. So when we build a portfolio, particularly in the mutual fund, we're tapping into firms like Calvert and Pax and Walden and Parnassus, right? These are firms that date back 30 or 40 years on some of their mutual funds that have some orientation towards faith-based or ESG or socially responsible, right? So they have decades of experience and skill that we can leverage. Within the high net worth space, we're able to use that exact same chassis, if you will, and incorporate also some individual stock management, the ability to look at whether particularly large cap or maybe even in some cases small cap and international, and be able to do some very custom and detailed stock selection that we can either build around a client's needs. So if they have certain names that they'd like to add in and restrict, we can do that. Or if we want to take a position that they own and build around it, we can do that there. But the thinking is still very much the same, which is leverage these skilled third-party managers in the asset allocation that we determine along any number of risk profiles, and then where possible, be able to customize to individuals' needs.
And my understanding is that there are also index or ETF exchange traded funds that are ESG oriented as well.
There are, so that's certainly an area that has, obviously expanded incredibly over the last 2 decades, the passively managed index space around ETFs. And I think it's interesting that you raise ETFs, the largest known, sort of family of those exchange traded funds, of course, is BlackRock, which owns iShares. And BlackRock CEO Larry Fink, within the last year, has been a very strong advocate of sort of walking this walk around values-based. And he's talking about BlackRock as a firm, right? He's talking about their identity. And so he's a big believer in this shift. And so to have, an investment vehicle in portfolios that matches that can sometimes cost reduce is also something that, we want to be able to build into our ecosystem. So generally speaking, as an active manager, we're going to have actively managed funds and SMAs, but where appropriate, we will also incorporate in a passively managed index to be able to get that asset class very cost effectively.
Jeff, when I'm talking to clients about this approach, and some clients ask, do I need to sacrifice returns, or is this going to cost me more? Could you comment on that?
Yeah, it's been a great mystery, I think, for a number of years, or at least one of the things that people utilize as maybe an obstacle to changing an investment strategy that's long-term and proven out like, traditional portfolios have been. The long and the short of it is that there's increasing evidence through meta studies and additional research that the outcomes related to a values-based portfolio very heavily skewed towards neutral to positive. In many, I think some words, upwards of 60 to 70% of the outcomes on those studies trended towards splitting between those two outcomes. And a lot of that is, one, being able to execute better on some of these, on the part of some of these managers in the ESG space, the greater availability of data and the fact that companies are required more than ever to present data, present data and share data. And also the makeup of what we would consider to be the market has changed dramatically in the last 20 to 25 years. The concerns around performance really stem from a time when oil companies and large industrial companies were the biggest components of the S&P 500. So to think about removing those companies off the top because of what they were investing in and the products that they were involved with was a challenge and considerable. You may actually end up removing 30% of the index at one point, in the late 1980s when Exxon was the biggest company in the world. That isn't the case today. The nature and the constituency of the index has changed significantly. Most of the companies that make up the index now are these, what I would consider to be newer economy, firms and companies. So, off the top, you see things like carbon emissions and carbon footprints and environmental impact drop dramatically just because of the businesses that they're in. And so taking an Exxon out of a portfolio or a Chevron out of a portfolio isn't as problematic as it might have been. And so you're able to sort of replicate more of the index. You're able to do this stock selection and do your screening and still have 90% of the universe from which to still choose your portfolio. So I certainly think that's a big part of the driver of some of the really, positive performance around value-based portfolios. Quality being certainly a second. So if quality is doing well, there certainly is going to be, a natural gravitation of some of these names to do well additionally. So yeah, I think performance, it's interesting too, Peter. One of the things that I've been very surprised about is more and more investors who care about this and investors who really want the portfolio to reflect what they, sort of hold near and dear are really less concerned with the performance in the traditional sense of, against an index or against some type of a benchmark. There's an acknowledgement that clearly it's an investment vehicle with a goal to attain a certain level of either appreciation or income or something along those lines. But there seems to be less of a concern around keeping pace with a benchmark that at the end of the day does not reflect that which is important to the investor. And so it's almost like there's more of a sense of forgiveness or latitude on part of investors. Whereas conversely, if an investor who is deeply entrenched in this finds a holding or two or three in the portfolio that they don't like, that presents a bigger problem to them. So it's refreshing in the sense that the integrity of the portfolio is being focused upon with sort of greater importance, and performance is, maybe secondary. But the fact of the matter is performance has been very good in the last couple of years, last year in particular. And, that obviously isn't going to be the case every year. There's going to be, periods of time when maybe a momentum, type of stretch might drive names higher, or, a sector like energy, which, again, we don't exclude it as a whole, but we're certainly going to be probably lighter on an energy than maybe an active manager was leaning into that space. And if that recovers significantly, you could find a portfolio lagging. But again, that's a forgivable sin for a lot of these investors who care much more about what's in the portfolio than necessarily keeping and being tied to a benchmark.
Yeah, and I think what's important for our clients and the people that we speak to is about meeting objectives. Are they able to do what they want to do when they want to do it over their lifetime and their children's lifetimes? And so returns are often very important, but risk management is also really important. And if this approach, in theory, is reducing overall risk, that those risks that might be controllable, then that's a value. And over time, my sense is that clients are going to get to the same place. They're going to be able to meet their objectives. So if these value-based investment strategies are important, then it's not a sacrifice of returns.
Yeah, that's right. And the performance discrepancy, between any, in any one year, could certainly favor one over the other. I look at 2020 in particular, some strategies that were, very much loaded into those tech names, which were the only things that seemed to really do well when the rest of the market was absolutely falling apart. That's not, to pardon the pun, that's not a sustainable approach over any length of time, right? Those names aren't going to outperform forever. And we're certainly seeing evidence of that this year, where some of those large tech names have been punished pretty severely. It's in over time, right? And that's the thing about diversification, right? It doesn't work every time. It works over time. And that's kind of what sustainable investing or values-based investing is too, right? At its core, right? Over time, right? The belief is that these companies that, are attractive from traditional financial characteristics as well, but also attractive from some of these ESG standpoints over time is going to offer a competitive return and will allow the investor to achieve their goal or objective, as you stated.
Jeff, how does an investor pivot from a traditional non-socially responsible or value-based investment strategy to an ESG investment strategy? And what do they need to consider when they do that?
Well, clearly, the first, step in that process, I think would be, the investor identifying certain themes that are important, to them, as far as, are they really trying to exercise some type of a viewpoint in their portfolio, right? That requires maybe a different level of portfolio construction, right? That requires a different focus. Because I will, before I kind of expand on that, I will say that a lot of firms, I've been pleasantly surprised by this. A lot of firms have been incorporating ESG into their normal process, their normal stock selection process, without actually calling it an ESG investment. I'll use Capital Group as an example. They have sort of ESG built into their mechanisms and the way that they are looking at companies and the way they optimize their portfolios. They just don't brand their strategies ESG, and it's not across their entire platform. So, that's sort of a long way of saying that this thinking is already, creeping into or has been in place within the industry, right? Even without it being designated as a values-based portfolio. But, to go back to your original question, if there's an identification of things that are important, whether it be causes, whether it be, industries or so forth that maybe pose a moral kind of complexity to an investor. If there's something about a traditional portfolio that isn't reflective of, what it is that they really believe in and what they want their money to be going towards, then clearly, that's the first. I think that would be the first step towards maybe identifying that a values-based portfolio might make more sense. And then, really it's just a matter of, engaging, their advisor and talking about, how they can go about sort of exercising that viewpoint, right? What are the different levers that they want to be able to have access to? Is it something as simple as they want to be able to put a few names in that they feel good about, that they want to be able to keep a few names out that they feel bad about? Is there something, broader that they're trying to sort of achieve? A lot of it is an outpouring, as sort of I began my comments in our discussion, is sort of an outgrowth of the normal planning dialogue that takes place. It's an additional section, that we kind of tack on to it, where we talk about those things. What are the things that are important to them, right? Not just, oh, you're another year older, or you're closer to retirement, or, your son or daughter is going to college. Those are sort of life events. There's a whole backdrop behind that around the things that kind of drive people, their motivations, the things that they gravitate towards and are sort of repelled against. And so when we have those conversations, it becomes pretty clear, whether or not an investor really is looking for something different that we would need to build a portfolio along these lines.
Mm-hmm. I think as far as implementing these kinds of strategies or transitioning them traditional to an ESG orientation, I always think about taxes, and IRAs, tax deferred accounts are really easy to transition because we don't have any tax issues. The security can be sold within the context of the retirement account, and gains are deferred. You don't have to pay taxes currently. It becomes those non-retirement or taxable accounts that can get a little bit complicated. Don't you agree?
Yeah, I mean, with any movement between sort of investment strategies or change in investment approach, one of the first things we certainly are looking at when we're engaging investors is, what are the ramifications to this? One, from a risk standpoint, are we able to keep that risk, commensurate with where the risk has been? And two, is there a way to get directly to their invest at a low level of tax impact, or is it going to require some type of a transition? And so, if the determination is made that we want to be able to get into a values-based portfolio, that it's certainly critical and timely that we do so, what we might do is just take a look at a part of the assets that we could, turn over fairly with low impact and get it at least started into the portion of the portfolio that would make sense from an investment standpoint and a values-based standpoint, and be able to maybe stage out the rest. Changing investment strategies, can be a challenge, and it can sometimes take a lot of discussion back and forth before determining that that's the right move to make. And so, whenever doing that, I'm going to certainly make that as simple and lenient from a tax standpoint as possible. But IRAs, obviously it's a very simple move to be able to make that. Non-IRAs, I would still think that we'd want to make sure that the investment approach matches what they're looking for, and that taxes don't necessarily dictate that. It's kind of saying, don't let the tax tail wag the dog, right? Particularly given that we don't know where tax rates are going to be, a year or 2 years or 3 years from now. We kind of have the known right now, and we have the unknown. And so, if the approach is deemed to be the right one, we want to make sure that we get into that portfolio in a very timely manner.
Yeah, it can take time. It to transition. It could take years, and that means that the clients have capital gains that they have to deal with, and that's not a bad thing.
No, it's certainly it's very funny. And obviously, nobody likes to pay taxes, and we always seem to forget that it's really just the result of what has been a tremendous market really for a decade plus now. And so I think that's why when we look at values-based portfolios, again, as I've said earlier, a lot of it has to do with an investor's input. And so the tax discussion just allows us another point of dialogue to be able to have a discussion and have the investor have some input, right? What are some thresholds that they would be comfortable with in terms of realizing those gains? Over what time frame would they be comfortable realizing those gains? And let's make sure that the portfolio meets those objectives. So it's really just another area for us to be able to, quote unquote, customize the experience.
Yep, I think that's right. Well, Jeff, this has been such an interesting conversation. Many of our clients that we speak with are concerned about this area. They want their investments to match or to meet their values. And these are conversations that we have. And I can tell you that Aris is really a primary resource for us as a financial planning firm to impact client accounts and to implement these kinds of strategies. So I thank you for all of your past work with my clients, but also I look forward to having these conversations with you and many of the clients that we work with in the future. So thanks so much for spending the time and talking about, I think, a really interesting and important subject.
Well, it's certainly my pleasure, and it's our pleasure as well. And we appreciate the chance to be able to have these discussions. They're fun isn't the right word, but they're interesting, and we can learn a lot about our investors by having these conversations, and we look forward to having a lot more of them.
Great. Thanks.
Gentlemen, this has been a fantastic podcast. Jeff, thank you so much for being a great guest on the show. So much information, so much to digest there. Peter, I know that this is something that you have a conversation with your clients about, but there's a lot more people listening to this podcast than just your clients. So if people are concerned about either A, what they have in their portfolio that may be against what their values are, or if they want to make sure that they are investing in companies that are doing good in this arena, can they reach out to you and have that conversation? Oh,
absolutely. I think probably the best way to reach out to us is go to our website, and our contact information is there. Our website is raskinplanning.com.
Fantastic. Again, Jeff, thank you so much for being on the show. Peter, of course, thank you for bringing him on the show. And our last thank you is always reserved for you, the listening audience. Thank you so much for tuning in and listening to the Wealth is in the Details podcast with Peter Raskin. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Peter comes out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share these podcasts with your friends and family. Again, thanks so much for listening today. For everyone at Raskin Planning Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Wealth is in the Details podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Lincoln Financial Advisors Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Peter Raskin is a registered representative of Lincoln Financial Advisors. Securities offered through Lincoln Financial Advisors Corporation, a broker, dealer, member SIPC. Investment advisory services offered through AssetMark Consulting, a division of Lincoln Financial Advisors, a registered investment advisor. Insurance offered through Lincoln affiliates and other fine companies. Raskin Planning Group is not an affiliate of Lincoln Financial Advisors. Lincoln Financial Advisors Corporation and its representatives do not provide legal or tax advice. You may want to consult a legal or tax advisor regarding any legal or tax information as it relates to your personal circumstances.